will be interesting to Gary, who we'll hear from later. Once upon a time, this was sort of like what the New York Stock Exchange floor looked like. You probably see this picture, lots of people yelling and screaming, lots of paper on the floor. Some of these fellows in blue jackets were brokers, and some were clerks, and green, orange jackets, whatever. And at the center of each one of these posts was a fellow who was known as a specialist. And his job was basically to bring buyers and sellers together. And he sometimes deployed his own capital to do that. When no one else wanted to buy, he would buy. And when no one else wanted to sell, he would sell. And that was sort of his job. And for a long time, that worked pretty well. And then, of course, computers sort of became more and more important on Wall Street. They started in the back office and eventually migrated their way to the front office. And what people started to realize was that there were some limitations to the specialist model. The limitations really were that even if you were a super specialist, if you were really good at what you did, you could really maybe focus on 2 or 3 active stocks at any one time. If you were trading Ford and General Motors, let's say, at the same time, and then something happened in the automotive industry that caused both of them to go down, all of a sudden you'd be swamped with all these guys yelling and screaming at you, sell, sell. And so there's nothing inherently wrong with that, but because of the limitations of what you can do as a person, it turned out that there were some problems. Like, for instance, you'd end up with concentrated portfolios, a lot of exposure to just Ford or just General Motors or wherever your stocks were. And that, because of that exposure, you basically had to widen your quotes, widen your spreads, and that led to higher prices for investors. It's also harder to manage your risk when you're a single person in the middle of all this and trying to do all this stuff at the same time. And finally, if you're a firm that employs a lot of specialists, it's hard to coordinate among all the different specialists to do sort of the right thing at any given time in real time. So at some point, people figured out that maybe a computer would be better in this, or maybe a computer could help this process. And of course, the idea was to make not only the specialist function more efficient, but to make markets more efficient. And today, although there's still a floor, and there are people down there, but not nearly as many. And these CRT tubes are all gone now, the whole flat panels and stuff like that. But here's really where most of the trading takes place today. This room, probably somewhere in New Jersey, there's a big room. NASDAQ has one in Carteret, New York Stock Exchange has one in Mahwah, and there are a couple of them. But basically, most trading goes through servers and in the case of high-frequency trading, the people that founded modern markets, they account for roughly 50% of all trading in today's markets. So what has that done? Well, really, the important thing to understand here is that because things moved away from that sort of human specialist and human market maker model to an electronic model, people were better able to control their risk, able to trade more stocks with fewer people, and eventually what started to happen was, well, let's take a look. So this is starting in 2005, and as I said, really electronic trading probably started in the late 90s in earnest, mid to late 90s. But as you can see, starting in 2005, it really started to ramp up. Even though it shows a little bit of a drop-off up to 2012, I think that's more the methodology. The fact is that electronic trading and high-frequency trading is a dynamic industry, and it's very exciting. As John was saying, I highly recommend it for people in your position. You should definitely look into it, especially if you have a technology background. Anyway, high-frequency trading has been going up through the 2000s, and look what happened. So this is the cost for investors. At the same time that the amount of high-frequency trading has gone up, the cost for investors has gone down. And what do we mean by that? Well, when we look at trading costs for investors, of course you think about things like commissions and that kind of stuff. And that's important. It's gone from, I remember it was $80 a trade, $100 a trade today, less than $10. Some places it's even free. But even more important is the spread, the difference between the bid and the ask price on any market. So let me give you an example. So when I started at Goldman, I remember that one of the most liquid stocks in the world, General Electric, used to trade, the minimum spread was an eighth, but quite often you see a trade with 25-cent spreads, quarter spreads. So that means that if you're the average retail investor buying only, let's say, 100 shares, you might have been paying an extra $25 for that trade, just in terms of the spread cost, put the commission aside. Today, that amount, that 25 cents, is down to really less than a penny. And so investors really have saved, and investors really have made out very well because of the rise of high-frequency trading. And just like in other industries, if you think about other industries where technology has sort of displaced human intermediaries, costs have gone down. If you think about what, for instance, what the book business was like before Amazon, you had lots of bricks and mortar, and listen, I love bricks and mortar bookstores, I love browsing and reading and so on, but the one thing that no one can deny is that the cost of buying books has plummeted. And so retail consumers of books have really never been better off. Very similar thing in our markets today. So I think that this is one of the great untold stories about high-frequency trading and the electronification of markets, is that investors have never been better off. We like to say that today we have the best markets ever. And it's true, especially in the United States. You know, Adina made an interesting point that she said NASDAQ is really an intermediary, and they are. But within NASDAQ, there are other intermediaries who, for the most part today, are high-frequency traders. And, you know, so the high-frequency traders have become the intermediaries who will commit capital, who can bring buyers and sellers together. And what you should expect from an intermediary, you may not, you know, sometimes people think that they're not necessary, sometimes people think they're very necessary, but the most important thing that you should expect is that they take as little as possible out of the trade. And that's exactly what this chart shows, is that the modern day intermediaries in our markets work for less money than they ever have in the history of markets. So that's what I wanted to say about that. High-frequency trading has made the markets much, much better. So let me talk a little bit about modern markets, why we got started, and you know, why high-frequency trading maybe has gotten a little bit of a bad rap. Some of you may have read a book. This book came out. It's called Flash Boys. I listened to that. It's written by Michael Lewis, great author. I loved reading his books, most of them. On this one, I think he just got it wrong. He didn't do his research, didn't do his homework, didn't really talk to high-frequency trading firms before he wrote the book. And as a matter of fact, a number of books have come out that sort of debunk a lot of what was written in that one. We actually brought a few copies, not enough for the whole room, but feel free to grab a copy of this book called Flash Boys Not So Fast. It wasn't written by us, but by a former high-frequency trader that sort of goes through the original book and sort of debunks it chapter by chapter. If anyone wants a copy, send us an email, we'll get you a copy. But you know, when we talk about Flash Boys in the book and all the hubbub that surrounds high-frequency trading, people say, well, are you angry with Michael Lewis? And, you know, I mean, what do you think about what he said? And the interesting thing is, well, yeah, we're angry, but you should be angry too. Everyone should be. We're not angry because of the unfounded allegations. We're not angry because he didn't bother to talk to high-frequency trading firms before writing the book. And we're actually not even angry that he's refused to have a dialogue about the book since he wrote it. But what really makes us angry is this. So when Flash Boys came out, which was right here, it's actually March 30th, but let's say April 1st, a little more than 2 years ago, Michael Lewis came out and he went on 60 Minutes and he said, the markets are rigged. And he scared the living daylights out of a lot of people who actually believed it. And if you had believed it, and if you had stayed out of the markets when he said that, you would have given up a 16.3% upward move in the S&P. And if all you did was use a basic strategy of reinvesting your dividends, would have given up more than 18% return in just the last 2 years. All you had to do was open an account with Vanguard and one of their S&P funds, or buy the Spiders or whatever, very simple transactions. If you had listened to that and thought that the market was great and stayed away, you would have given away 18% return. And that's really a shame for investors, people who are saving for college, people who are investing for retirement, people who are trying to buy a house. This is real money, and this is something that people have to understand when you have these unfounded allegations. So the 4 firms that founded Modern Markets, Tower Research, Quant Lab, GTS, and Hudson River Trading, sort of heard all this noise coming out. Some of it was about the book, there were some other people writing stuff and so on, and they felt that there was a need to have an organization that would not just represent them, but that could talk about what it is we do and how we do it and why it has been beneficial for investors. And that's why Modern Markets was founded. And they asked me to lead it. It's been a great time for me. I've been doing it for about 2 years now, I guess. I will be here for the inter-networking session, what we call it. So please feel free to come up to me and ask any questions that you'd like. So, thank you very much.